Assalamu alaikum. This is Investment and Portfolio Analysis course, lecture 14, continuing from our previous session on analysis of financial statements and security valuation. In the previous classes, we have learned about liquidity ratios, profitability ratios, and solvency ratios. And today we will be concluding the ratio section with efficiency ratio and market ratio. Starting with the efficiency ratio, we can call that activity ratio, and also it can be said asset management ratios. Why? Because they measures or they assesses a company's ability to efficiently manage its assets and generate revenue. These ratios usually provide insights into the company's operational efficiency and its utilizations of resources, how much resource they have and how can they are creating the value, or how can they are changing the value through their resources, and how much money they are generating from those assets. Some efficiency ratios can be mentioned, which are asset turnover ratio, inventory ratio, accounts receivable turnover, and accounts payable turnover, among many. We will discuss our these four ratios through a summarized version for your better understanding. Asset turnover ratio measures the ability to generate sales revenue relative to its total asset. How much the company, how much asset does a company have, and how much they can generate from those, how much they can do good in sales. That is measured through asset turnover ratio. It indicates that how efficiently the company utilizes its asset to generate the revenue. It can also be said that the ratio indicates that the amount of revenue generated per unit of total assets. A higher asset turnover ratio indicates that the company is more efficient in utilizing its assets to generate sales, which indicating that the company generates more revenue from a given level of assets. On the other hand, a lower asset turnover ratio may indicate that the company is not effectively utilizing its assets to generate sales revenue, suggesting that the company may have excess or underutilized assets which can potentially impact profitability. So the decision should be accepting the higher one among or between two investments. Moving on to the inventory turnover ratio, which indicates how effectively a company manages its turnover, manages its inventory. It assesses the number of times a company sells and replaces its inventory within a given period. It can be interpreted as how quickly the company is able to sell its inventory and restock it. A higher inventory turnover ratio suggests that the company is selling its inventories more frequently, indicating efficient inventory management and a shorter holding period for inventory. Conversely, a lower inventory turnover ratio may indicate slower sales, excess inventory, or even inefficient inventory management practices. It suggests that the company may have a longer holding period for inventory, potentially tying up capital and increasing carrying costs. However, accounts receivable turnover and accounts payable turnover are quite similar. Both of them measures how efficiently a company manages its accounts. For receivable, its collectibles from its customers, and for payables, paying its suppliers. So first we will talk about the accounts receivable turnover, which indicates the number of times on average a company collects its account receivable during a specific period. It can be interpreted that how quickly the company collects payments from its customers. A higher turnover ratio indicating that the company is able to collect its account receivable from more frequently, which is meaning that the company is efficient in credit and collection management, obviously. Conversely, lower account receivable turnover ratio may indicate a slower collection of payments, potential credit issues, or inefficiencies in collection process may also. It also suggests that the company may have a longer average collection period or challenges in managing its accounts receivable. So in every cases we should accept the higher one, the higher ratio, the higher turnover one, so that we can say that the company is doing well. The accounts payable, we have said earlier, it manages how effectively a company manages its accounts payable and it pays suppliers. The ratio indicates that how quickly the company pays its suppliers and manages its accounts payable. A higher accounts payable turnover ratio suggests that the company is paying off its accounts payable more frequently, indicating efficient management of payables and potentially favorable payment terms with suppliers. But a lower accounts payable turnover ratio may indicate slower payment and of obligations or potential issues in managing payables. It suggests that the company takes longer to pay its suppliers, potentially indicating cash flow constraints or even difficulties in managing working capital management. So now we will see an example including these 4 ratios and how to interpret them. We'll see that inshallah. So here's an exercise for you guys to do, to find the asset turnover, inventory turnover, accounts payable turnover, and accounts receivable turnover, and interpret them. This can come in your exams, and you have to interpret them. In this course, our main target is to interpret the results, not finding the result, because it's very easy, and you may have done that in several courses, most probably. So let's see the answers and let's interpret the results for you, so that it will be easier for you to understand what these numbers mean. For the first one, asset turnover, company A has 5 times and company B has 0.05 times, which is a serious issue. So the 5 indicates that the company A generates 5 taka in sales for every taka invested in its asset. A higher asset turnover ratio suggests that a company A efficiently uses its asset to generate revenue, but company B is only generating 5 paisa in sales for every taka invested in its asset. A lower asset turnover ratio indicating that company B is not efficiently using its assets to generate revenue, which might be expected for a real estate investment firm, as they typically have a slower turnover assets compared to retail or manufacturing firms. But if both of them are manufacturing firms, then company A should be accepted or should be invested in company A. Similarly, in company B, in inventory turnover ratio, company A has 5 times, meaning the company A can sell to their entire inventory 5 times during a year, whereas company B can only do that 1.25 times. For accounts receivable turnover, company A has 10 times, meaning that company A can collect its outstanding receivables 10 times during a year, whereas company B can do that only 2 times. And similarly, company A can pay its suppliers or pay its payables 12 times on a year average, on an average, whereas company B can do that only 6 times. So for each and every case, company A has a better ratio, and we should choose company A if we have to choose between company A and company B. So you guys have to write it in this in your exam paper, the interpretation and the equations also. So moving on to our market ratios, let's talk about the market ratios. It can also be called as market valuation or security valuation ratios, which provide insights into a company's valuation and its performance in the stock market, how they're performing, and how a company's stock price is performing in terms of their financial performance or market value. It can also be some market ratios or security valuation ratios can be mentioned here. So, which is earnings per share (EPS), which is then price to earnings ratio (PE ratio), or dividend yield ratio, or price to book value ratio. So we'll learn about 4 of these ratios, inshallah, and we will see another example including these ratios and their interpretation as well. Market ratio, starting with the EPS, earnings per share, which measures a company's profitability on a per share basis, meaning how much profit a company earns on per share. It also indicates that the portion of a company's earnings allocated to each outstanding share of common stock. It is widely used by investors and analysts to assess a company's profitability and to compare the earnings performance of different companies within an industry. We can measure it by dividing the net income with outstanding number of shares. It indicates that the amount of earnings generated per outstanding share of common stock. It also provides insights into how effectively a company generates profits on a per share basis. It is also a key metric used by investors to evaluate a company's profitability and to determine the relative attractiveness of its stock. A higher EPS generally indicates higher profitability, although it's important to consider other factors such as revenue growth, profit margins, and industry benchmarks when evaluating a company's performance with EPS through EPS. Price to earnings ratio is a market valuation ratio or a security valuation ratio which compares a company's stock price to its earnings per share. It is one of the most widely used ratios to assess the relative valuation of a company's stock. It also indicates how much investors are willing to pay for each dollar of earnings generated by the company. A higher P/E ratio suggests that the investors are willing to pay a premium price for the company's earnings, indicating higher growth expectations or market optimism about the company's prospects. The PB ratio, price to book value ratio, compares the company's stock price to its book value per share. It indicates market valuation of a company in relation to its net assets. So it is basically determined by dividing the stock price with book value per share. The result indicates that how much investors are willing to pay for each unit of the company's net asset. A higher PB ratio suggests that the investors are willing to pay a premium price for the company's book value, indicating a positive market sentiment and potentially higher growth expectations. Whereas the dividend yield is measured by dividing the dividend per share with the stock price. It indicates the percentage of the company's stock price that is returned to shareholders as dividends. the results indicate that the return of investment on investment from in dividends as a percentage of the stock price, it is if we get a higher dividend yield, it usually suggests that a higher income return for shareholders based on the dividends received relative to the stock price. Conversely, lower dividend yield indicates a lower income return from dividends compared to the stock price. This may be due to factors such as lower dividend payments, or it can be higher stock price, etc. So let's move on to the exercise. Students should do that. Should find the 4 ratios: EPS, price to earnings ratio, price to book value ratio, and dividend yield through the formulas, through the equations we have seen earlier. So now I will be discussing the interpretation of those ratios. For company A, we are getting a 5 taka EPS, whereas we're getting for company B 0.5 only, which means company A is generating more earnings per share, indicating a strong financial performance, efficient cost management, and higher profit than company B. The price to earnings ratio is indicating that company A, the investors of company A are willing to pay 20 taka for every 1 taka of the company's earnings, which might indicate that investors have higher confidence in the future growth potential of company A, as they're willing to pay a higher price relative to the earnings it generates. Whereas company B, the investors of company B are willing to pay 100 taka for every 1 taka company's earnings, suggesting that the investors have lower expectations of future growth or have concern about the company's financial performance. Price to book value ratio can also be seen as company A has a higher price to book value ratio 3.33 and company B has 0.71 only, which indicates that the market price per share is 3.33 times to its book value, which indicates that the market value of company A at a premium compared to its book value. It could be due to positive market sentiment or strong growth perspective or other factors that could affect investors' perceive. Dividend yield, we can see that 4% and 2% of the dividend yield, which indicates that it pays its shareholders 4% of the current stock price as dividends annually, but company B is only paying 2% annually. So that's the explanations or interpretations of our ratios. Now I've provided notes, question sheets, and also slides before our classes. So you should have been seen that or downloaded that from the portal. I'm showing you right now. I'll be showing you right now a summarized version of our ratios altogether with decisions and what they means. Hopefully this will help you to understand the ratios at a glance. Here is a summarized interpretation of ratios. Interpretation of ratios, where we can see what current ratio means and what should be the decision. We can also see quick ratio, cash ratio, gross profit, net profit, ROA, ROE, PE, EPS, debt to equity, interest coverage ratio, asset turnover, inventory turnover, accounts payable and receivable turnover, also price to book value and dividend yield. All these ratios we have learned so far in our 3 sessions, 3 lectures, and we'll be concluding the ratio part today, and we'll be starting the bond valuation in our next session, inshallah. Thank you very much for attending today's class. Assalamu alaikum wa rahmatullah wa barakatuh.